Hey everyone, I'm Michael. Let's just put it out there. If you've checked the news, scrolled your feed, or even just glanced at your phone lately, you've seen the panic. People are freaking out over the stock market. Headlines are blaring disaster. Social media is buzzing. The main message? Get out now, before you lose everything. It's everywhere. The stock market is finished. Trump's sending us into a recession. Sell it all while you still can. Honestly, it's fear on repeat. Everyone's asking the same question. Should you sell now before things get even uglier? But hang on. There's more going on here than what you see at first glance. If you let fear and headlines do your thinking, you're setting yourself up for a huge mistake, maybe the biggest financial mistake you'll ever make. I've been investing seriously for decades. I'm obsessed with how the market ticks, what makes it move, what sends it up or down. And since so many of you are new to investing and follow this channel, Investor Voice, I feel a real responsibility to give it to you straight. No spin. Just my honest take on what's actually happening right now. So, before you panic, before you hit that sell button, take a breath. Let's pull back for a second and look at the big picture. When you start to understand what's really behind all this chaos, you stop reacting out of fear and start making smarter moves. Markets never crash for no reason. There's always a trigger, and this time you can trace it all back, directly or indirectly, to one person, Donald Trump. Now don't get me wrong, this isn't about politics. I'm not here to take sides or preach. I'm a British investor looking at this from the outside. My only concern is how this affects us as investors, regular people trying to grow our money, protect our savings, and look after our future. That's what matters. Tonight I want to break down the three main triggers behind this crash, why they matter, and most importantly, what you can actually do to turn all this madness to your advantage. Because believe me, in every crisis, there's a shot at opportunity. You just need to know where to look. Let's get into it. First up, Trump's trade war. It's the obvious culprit, and everyone's talking about it. Trump loves to play the tough guy, the master negotiator, the champion of American jobs, the guy who's not afraid to shake things up. And you know, in some ways, that's what he's doing. But here's where it gets messy. These trade wars, they could make your groceries more expensive, mess with global supply chains, and maybe even spark a recession. The last time America tried something like this on a big scale, it helped kick off the Great Depression. Jobs vanished, the economy tanked, and now, almost 100 years later, it's like déjà vu. The market's already taking a beating, prices are creeping up, and if this keeps spiraling, it won't just hurt Wall Street. It'll hit you where it really counts, your wallet, your day-to-day spending, your sense of security. Flashback to 1930. The U.S. slapped huge tariffs, basically taxes, on imports. The idea was to protect American businesses. It was called the Smoot-Hawley Tariff Act, and it turned out to be a disaster. At first it sounded like a win. American companies would get a break from cheap foreign competition. More stuff made at home, more jobs. On paper, it looks solid, but nobody really thought through what would happen next. Other countries hit back. Nations that used to trade with the U.S. started jacking up their own tariffs. Suddenly, American companies couldn't sell as easily overseas. Global trade slowed to a crawl. Businesses folded. Millions lost their jobs. Instead of helping, those tariffs took a bad recession and turned it into the Great Depression, one of the worst disasters in economic history. Fast forward almost a century, and here we are again. Trump's brought tariffs back in a big, bold way. Back in February 2025, Trump slapped a 10% tariff on Canadian energy and hit the rest of Canada's exports to the U.S. with a 25% tax. Canada didn't just sit there. They fired right back with a 25% tariff on American goods. Then, in March, Ontario piled on with its own 25% surcharge on electricity exports heading to states like New York, Michigan, and Minnesota. Honestly, Ontario's move, it was mostly for show. It wasn't going to wreck the U.S. economy, but Trump didn't just shrug it off. He doubled down, jacking up tariffs on Canadian steel and aluminum to a whopping 50%. That one hurt. It hammered Canadian manufacturers and at the same time made steel more expensive for American companies that need those imports. So, why does any of this matter to you? What's Canadian steel got to do with your investments? Here's the thing. Tariffs always look good on paper. They're supposed to punish foreign competition and boost American manufacturing. But in real life, regular people take the hit. I've seen this play out firsthand. I run a business that makes products and buys raw materials from China. When tariffs go up, businesses like mine don't just eat those costs. We pass them on. Pretty soon you're paying more for cars, appliances, electronics, anything with imported parts. And it doesn't stop there. Food prices climb too, thanks to supply chain headaches. Tariffs hit farm goods, packaging, shipping, all of it. The extra costs trickle down, and suddenly everyone's grocery bill is higher. Household budgets get squeezed from every side. And here's another twist. Other countries aren't just waiting around while Trump raises tariffs. They're busy making new trade deals that cut the U.S. out. China's leading the charge with the BRICS group, Brazil, Russia, India, South Africa, finding ways to rely less on American trade. The more the U.S. pulls back, the more the rest of the world looks elsewhere. That's not just a short-term headache. It sets up problems that could last well beyond the next election. So what do I make of all this as an investor? If Trump really pushes this trade war to the edge, history tells us it does more harm than good. Sure, a few industries might get a bump at first, but higher prices, strained global relationships, and a slower economy are a steep price to pay. But look, I don't actually think Trump wants these sky-high tariffs forever. It might sound nuts, considering everything he's done, but hear me out. Trump's a deal maker at heart. Guys like him and me don't start trade wars for the thrill of it. They use pressure to get what they want at the negotiating table. I think he's using tariffs as leverage, not as the end game. So what's he really after? My bet, he wants free trade, but only if it tilts the playing field toward the U.S. He wants to knock down foreign barriers while keeping America's where it counts. If he manages to pull that off and cut better deals, it could actually benefit the country. But here's the catch, and it's a big one. This whole approach creates a ton of uncertainty. One minute there's a new tariff, the next it's delayed or scrapped, and officials keep sending mixed messages. The result? Markets get nervous. Investors hate not knowing what's next. If this drag-out keeps going, if the uncertainty hangs around month after month, it could rattle investors so much that the economy starts to slip toward recession. Even Trump's own team has said they're willing to take that risk. Right now, it's not just the tariffs that have markets on edge. It's the not knowing what's coming next. And in the world of investing, nothing kills confidence like uncertainty. Now let's talk about another big trigger. This one's less about the economy and more about global politics, but it's just as crucial. Trigger number 2, Trump's attitude toward NATO. He's questioned the value of the alliance that's kept Western countries safe for decades and said the U.S. shouldn't keep footing the bill to defend allies unless they start paying more for their own protection. On the face of it, that sounds fair enough. Why should Americans pay for Europe's defense? Why can't other countries chip in more? But here's the catch, especially if you're looking at this from an investor's point of view. If the U.S. pulls back from NATO, it leaves a gap. Russia or China would love to jump right in. And markets? They freak out over uncertainty. The moment investors think global stability is on the line, they bolt. If NATO weakens, Russia could get bolder in Europe. Suddenly you're looking at more conflicts, countries scrambling to adjust, and the U.S. no longer playing global cop. That means more spending on weapons, shaky trade, and wild swings in energy prices. The stock market hates that kind of chaos. Even just the rumor of instability gets investors jittery. When they panic, they don't wait around. They sell fast and ask questions later. All that selling just pushes the market down even more. Now let's talk about trigger number 3. This one's controversial and honestly kind of fascinating. There's a theory out there that Trump is tanking the stock market on purpose. Yeah, I know. That sounds nuts. Why would any president want the market to crash? But there are a few things to think about. For starters, Trump really doesn't like high interest rates. He's called them ridiculous and has slammed the Federal Reserve for keeping them up. He wants them lower, wants easy money, wants the economy to take off. Here's where it gets tricky. The Fed is supposed to be independent. Trump can't just tell them to cut rates, but the Fed reacts to economic conditions. If the market crashes and a recession looks unavoidable, the Fed has to step in and slash rates to keep things from totally falling apart. They don't really have a choice. So why does Trump care so much about lower rates? It's about more than just juicing the stock market. Look at the national debt. Right now, the U.S. owes about $36.5 trillion. When rates are high, the government spends a fortune just paying interest. It's like having a giant credit card bill. Say you owe $36,500 and the card charges 10% interest. Every year you owe $3,650 in interest alone, and that doesn't even touch the original debt. Now imagine the rate drops to 3%. Suddenly you're only paying $1,095 a year in interest. That's a $2,555 yearly saving, money you can actually use to pay down what you owe. That's what Trump might be angling for, just on a massive scale. If the Fed cuts rates, the government can refinance the debt for way less, saving billions, maybe trillions, over time. Presidents have always preferred lower rates, even if they won't say it out loud. The math is hard to ignore. If Trump can pull this off, if he sets things up so the Fed has to cut rates, it might go down as one of the boldest economic moves in history. Use a market drop to fix a debt problem? That's next level thinking. I'm not saying this is definitely the plan. I'm not in the room when these deals get made. But as an investor, I have to think about every angle. If this theory holds up, we're not headed for a long-term collapse. It's more like a short-term storm before a big comeback. So you're probably asking, Michael, how do I actually make the most of this? How do I stay sane and keep my money when everything's spinning? Let's get one thing straight. Stock market crashes aren't some freak accidents. They're just part of the ride when you invest. Every few years the market tanks. People freak out. The news goes wild, and it feels like the world's ending. But honestly, if you look at history, that's just noise. Here's the truth. Every single time the U.S. stock market has crashed, it's bounced back. Every single time. Not just most of the time, every time. The folks who panic and sell, they usually end up locking in their losses and missing the recovery. But if you keep your cool and invest wisely, you're way more likely to come out on top. Instead of losing your mind when things get rough, use that energy to get ready. Make smart moves. Set yourself up for big gains when the market rebounds, because believe it, it will. Now, I'm not a financial advisor. I can't tell you exactly what to do with your cash. But I've been through my share of market crashes, and I've made millions by sticking to what works. I've seen the panic. I've heard all the "this time it's different" chatter. Here's what I've learned that actually helps. First, before you even think about investing in a shaky market, you need a solid financial base. I know I've said this before, but it's worth repeating. Build an emergency fund, enough to cover 3 to 6 months of your expenses. That's money you can get to quickly, and it doesn't care what the market's doing. Also, Knock out any high-interest debt, anything above 8%. Don't start throwing new money into stocks until you've got those things handled. Once you've got that base set, here's the upside. If you've never invested before, this is a great time to start. Stocks are on sale, plain and simple. Prices have dropped, so you're basically buying at a discount. Back in 2008, when the financial world looked like it was collapsing, I kept investing all the way down. I won't lie, it was scary. The headlines were all doom, but I kept putting money in, month after month. Not long after, those investments doubled. Meanwhile, some of my friends panicked, sold at the worst moment, and missed the entire rebound. Nobody knows exactly where the bottom is. If someone says they do, they're lying. But if you keep investing while prices are low, you're picking up assets on the cheap. And when the market recovers, and it always has, you're in a strong spot. If you've been waiting for the right time to start investing, this is pretty much it. Not because we're at the bottom, but because there's so much uncertainty. And that uncertainty, it's where opportunity lives. Next, you need discipline and a long-term mindset. Market crashes aren't random. They follow patterns. Let me break it down. First, corrections. That's when the market drops 10 to 20%. These are common. They happen about every year or two. They're just part of keeping the market healthy. Then there are bear markets, drops of 20 to 40%. These show up every 5 to 7 years or so. On average, they last around 289 days. They hurt, but the market always comes back. And finally, you've got full-on collapses, drops bigger than 40%. These are rare. Think 2008 or 2000 or way back in the 1930s. Each time, the U.S. market not only recovered, but shot past its old highs. The biggest mistake newbies make? Letting emotions run the show. When stocks fall, people get scared and sell at a loss. When stocks climb, greed kicks in and they buy too high. That's the cycle, buying high, selling low, that trips up most investors. Don't fall for it. If you're already investing, honestly, the worst thing you can do right now is panic and sell. When you sell while the market's down, you lock in your losses for good. What could have just been a temporary dip on paper becomes a real hit to your wallet. Plus, you miss out when the market eventually bounces back. Instead, take a breath and look at it this way. If you've got some cash sitting on the sidelines, this is actually a chance to pick up more shares while prices are low. Stick to your long-term plan. One of the smartest ways to do this is with dollar cost averaging. Basically, you invest the same amount every month, rain or shine. When stocks are expensive, you buy fewer. When they're cheap, you scoop up more. Over time, this helps smooth out the roller coaster and cuts down the risk of bad timing. The best investors, they don't freak out during downturns. They see opportunities to grab good investments at bargain prices. Another big rule, don't put all your eggs in one basket. Seriously. Diversification matters, And it's even more important when things get shaky. If you go all in on tech stocks, crypto, or real estate, and that area tanks, your whole portfolio takes a hit. But when you spread your money across different things, stocks, bonds, gold, real estate, maybe a little crypto, they don't all move together. So if one's hurting, another might be doing fine. Personally, I like having a mix: stocks, bonds, some gold, real estate, even a small piece of crypto. They each react differently when the economy changes. Sometimes stocks are down, but bonds are steady, or gold holds up when everything else is rocky. And real estate, even in crazy markets, it can kick off rental income. You might also want to look at dividend-paying stocks, those companies that send cash your way every quarter. When prices are dropping, those dividends give you steady income. If you reinvest them, you're buying more shares while they're cheap, which could mean bigger gains later. Look, market crashes feel awful while they're happening. The news is screaming. People you know are panicking. It's easy to get swept up in the fear. But if you keep your head and stick to what works, you'll be the one finding opportunities while everyone else is running scared. Now's not the time to be afraid of the market. It's time to get smart, invest with purpose, and be patient. The people who stay cool and make good decisions now will be the ones who come out ahead when things turn around. Here's what I want you to remember. The stock market isn't a casino. It's not all luck. Over time, it rewards patience and discipline. Ups and downs are part of the deal. They always have been, always will be. The real question isn't if the market will recover. It will. But whether you'll be ready to benefit when it does. So take a breath. Turn off the noise if you need to. Focus on your own plan. Keep investing, keep diversifying, and remind yourself why you started. Thanks for sticking with me tonight. I know your time matters, and I really appreciate it. If you got something out of this, do me a favor. Share it with someone who needs to hear it. Maybe it's a friend on the verge of selling out, or a family member feeling overwhelmed, or someone new who just needs a little perspective. Send them the link, talk it over, help them avoid a big mistake. You could make a real difference. Go ahead and hit subscribe and join us here at Investor Voice. We're all about cutting through the noise and zeroing in on what actually shapes your financial future. Here, we call out the facts, set aside the hype, and focus on real strategy instead of getting caught up in fear. Make sure you tap the bell so you don't miss any future strategy sessions. We're building something real, a community of people who want to take charge of their money, and I'd love for you to be part of it. Drop a comment and tell me how you're handling this market. I read every single one, and honestly, I enjoy hearing your take. I'm Michael, this is Investor Voice, and I'll catch you in the next video. Until then, look after yourself and your money, and remember, every crisis comes with a shot at opportunity. You just need the guts to spot it. Good night. And here's to your financial freedom.